Q3FY23 earnings conference call of Brigade Enterprises Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. M.R. Jaishankar, Executive Chairman, Brigade Enterprises Limited. Thank you, and over to you, sir.
Good afternoon. Welcome you all to the Brigade Enterprises Q3 of financial year 23 earnings call. I am joined by our Managing Director, Ms. Pavitra Shankar, and Joint Managing Director, Ms. Nirupa Shankar, our Executive Directors, Mr. Roshan Matthew and Mr. Amar Mysore, and our Senior Management Team, Mr. Atul Goyal, CFO, Mr. Vineet Verma, CEO Hospitality, Mr. Om Prakash, Company Secretary, Mr. Pradyumna Krishna Kumar, Chief Business Development Officer, Ravi Ahuja, COO Office and Logistics, and Chidambar, CHRO of the group. Despite the market volatility and softness in the global economy, I am happy to report that Brigade has shown good operational results last quarter, with all our business verticals contributing towards our growth. We expect to sustain and grow the momentum in the coming quarters with a good pipeline of new residential projects, leasing business, and continued growth in the hospitality business to finish the year strong. Coming to the residential SBU, Q3 has been the best quarter for the financial year with net new bookings of 1.455 million square feet with a value of rupees 939 crores. The collection trend is also encouraging with rupees 884 crores over the first 3 quarters. Over the first 3 quarters, we have clocked a net sale of 3.74 million square feet and sale value of 2,444 crore rupees. Our year-to-date collections have also moved up to 2,737 crore rupees, which is 32% higher than the same period last year. In Q3, we had launched and sold out the first phase of Brigade Oasis, our first exclusive plotted development. We launched 2.5 million square feet in the first 9 months of the financial year and are working to launch another 2.5 million square feet in Q4 in Bangalore. Customer demand on ground seems strong despite the increase in mortgage rates across the portfolio of ready-to-move in under construction as well as new launch inventory. Construction activity continues to be consistent and collections are also on track. Coming to the office SBU, the leasing touched 1 million square feet for 9 months of financial year 23. There were 425,000 square feet of fresh leases done for this quarter. Net leasing was 330,000 square feet in Q3 FY23. Collections remained stable at 99%. Conversion on 2 major hard options at Brigade Tech Garden, Bangalore and World Trade Center, Kochi depict confidence in implementation of our clients' planned growth. 94% of the leasing tenants are from automobile and technology sector. To be precise, 52% from automobile and 42% from technology. Flexible co-working business, our buzzwords, has 99% occupancy in its 6 operational centers and foresees a 75% addition over its current capacity in the coming 6 months in Bangalore. In Q4 financial year 23, we aim to focus on leasing major vacant spaces in Brigade Tech Gardens and WTC Chennai. We'll be looking to close out our stock in BIFC, Brigade International Financial Center in Gift City, and Brigade Opus, Bangalore. As regards retail SBU, during Q3FY23, there was a 27% growth on like-to-like sales consumption over pre-COVID Q3FY20 across our malls. With the addition of Orion Uptown Mall, there has been an overall 40% growth in retail consumption for Q3FY23 over Q3FY20, which is pre-COVID. Retail categories like fashion and food and beverages have grown 18% and 13% over previous quarter of FY23. Other retail categories that had more than 30% growth are electronics, watches, eyewear, spa and salon. The leasing of malls had a good traction in terms of vanilla stores, wherein there has been an expansion in retail growth plans for categories like fashion and footwear. We have leased approximately 131,000 square feet in the past 9 months. Almost 1.07 lakh square feet are under fit-out across 3 malls. We are looking forward to seeing them operate by early Q1 FY24. Coming to hospitality, our hospitality business has continued its growth story in Q3 as well. There has been an all-round improvement in our numbers, with both our top line and bottom line registering higher than pre-COVID Q3 levels. Our occupancies reached 105% of the pre-COVID performance. Our revenues touched 118% and our AGOP reached 138% of the pre-COVID levels for the same period. Even ARRs, average room rates, an upward growth of 6% over pre-COVID levels. There was an encouraging growth in our primary demand segments like the F&B, revenues, banquet events and MICE activity picking up pace. Our focus now has been to improve our average room rates across all hotels. In addition, with a view to maintaining a healthy bottom line, we have continued to maintain a strict control on expenses, including leaner staff-to-room ratios. That brings me to the end of our business highlights. Thank you all for listening. I now request our CFO, Mr. Atul Goyal, to take you through the financial highlights. Take care and stay safe. Thank you.
Thank you, sir. Good afternoon, all. On behalf of the company, we welcome you to the earnings calls for Q3 FY 2023. At the outset, we are glad to inform you that our rating outlook has been upgraded to A+ positive from A+ stable by both ICRA and CRISIL. To start with consolidated financial performance for Q3 FY23, the consolidated revenue for Q3 FY23 stood at 859 crores versus 933 crores for the same quarter last financial year. The consolidated EBITDA for Q3 FY23 stood at 246 crores versus 269 crores in Q3 FY22. EBITDA margin have been maintained in Q3 at around 29%. Consolidated PAT stood at 43 crores compared to 46 crores for the same quarter. Consolidated PAT after MI stood at 57 crores compared to 78 crores in Q3 FY22. The real estate segment clocked a turnover of 559 crores and EBITDA of 16% in Q3 FY23. Real estate collections for Q3 was 936 crores versus 837 crores in the same quarter last financial year, increase of 12%. The leasing segment clocked a turnover of 200 crores in Q3 FY23 versus 167 crores in the same quarter last financial year and EBITDA of 69% in Q3 FY23. The hospitality segment clocked a turnover of 101 crores in Q3 FY23 versus 63 crores in the same quarter last, EBITDA of 21% in Q3 FY23. Overall collections for Q3 FY23 was 1328 crores versus 1095 crores in Q3 FY22, an increase of 21%. Coming to consolidated financial performance for 9 months FY23, the consolidated revenue for 9 months FY23 stood at 2,691 crores versus 2,100 crores in the same period last financial year, up by 28%. The real estate segment clocked a turnover of 1845 crores versus 1561 crores during the same last financial year, an increase of 18% and EBITDA of 14% in 9 months FY23. The leasing segment clocked a turnover of 564 crores versus 415 crores during the same period last financial year, an increase of 36% and EBITDA of 73% in 9 months FY23. The hospitality segment clocked a turnover of 282 crores versus 124 crores during the same period last year, an increase of 127% and EBITDA of 28% in 9 months FY23. The consolidated EBITDA for 9 months stood at 746 crores versus 605 crores during the same period last financial year, an increase of 23%. EBITDA margin stood at 28%. Consolidated profit before tax for 9 months is 213 crores versus a loss of 23 crores during the same financial year. Overall collections for 9 months FY23 was 3,962 crores versus 2,749 crores during the same period and up by 44%. So everywhere in 9 months we have our performance has been good, and everywhere our numbers have gone up as compared to last financial year 9 months. Coming to debt position and its breakup, gross debt of the company stood at 3,915 crores. There was an overall reduction of rupees 101 crores in gross debt and rupees 77 crores reduction in real estate debt, which has driven by higher sales and collection during Q3 FY23. The cash and cash equivalents stood at 1923 crores as on 31st December 22. Consequently, the company's net debt outstanding as on 31st December is rupees 192 crores, out of which BL share is 1294 crores. I would also like to highlight that 73% of our gross debt pertains to commercial portion, which is backed by rental income. Debt stood at 8.46%, that is an up by 71 bips as against 250 bips now in the increase in repo rate, and net debt to equity is reduced to 0.53 for 22 from 0.6 as on September 22. Thanks all, moderator, for Q&A. Thanks.
Should we open up for questions?
Sure.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on your residential portfolio. So, given your current track in terms of the pre-sales that you've seen during this quarter, you're on track to achieve sales in excess of 5.4 million square feet this year. And with a couple of new launches in fourth quarter, do we expect to see an upside to this estimate? And with Brigade moving from 8 million square feet launches in this year to possibly 12-13 million square feet next year, would you target sales number to be in excess of 7 million square feet or even 8 million square feet for FY24?
Hi Karan, Savitra here. I think Q4 is shaping up to be pretty good. We have a bunch of launches that have started coming out since January onwards, around 2.5 million square feet of launches in Q4. So I think the team is pushing aggressively to beat what we had originally indicated. That said, some of the launches we had planned for the next rolling 4 quarters. On Chennai, we may see some of it slip into the next financial year. So we're still trying to push and see what can be done in terms of beating, first of all, Q4 for FY23 and then beyond that.
Sure. And thanks, Pavitra. In an interview earlier today, you mentioned that the blended ASPs might go down due to plotted developments. So what part of your stabilized launch and sales do you see coming from plotted development over the next 1 year and 5 years?
So actually, we have development projects, one of which launched last quarter, and subsequent phases are launching this quarter, plus a new plotted development in Mysore also launched this quarter. In total, those plotted development projects are approximately 1.2 to 1.3 million square feet. So we will be selling that as quickly as possible. So there is some impact on Q3 realization itself. There may be some impact on Q4 and Q1 FY24 based on when the sales happen. Subsequent to that, we are still working and looking for plotted developments in our land bank. So as and when that happens, there may be some impact on realization there as well. But most of it you will see this past quarter, the current quarter Q4, and in the upcoming quarters.
Sure. Thanks. And secondly, on your leasing portfolio, we understand, the vacancies currently are in the SEZ office spaces. Some of the other CRE players have opted to denotify full buildings from SEZ to non-SEZ under the current rule. So do you wish to pursue something similar, or you would wait for the regulatory changes?
No, hi, Karan, this is Nirupa here. We're still seeing some good traction even in the SEZ projects. It's definitely going slower than what we had anticipated. But what we're doing is we're able to convince some of the occupiers who are not looking for SEZ space and get them into our properties by working with tax planners and consultants to help them understand how they can work out, their taxation-related issues. And we've been able to get quite a number of clients to move into our projects regardless. We're not looking to change any such strategy like that, but we've been given to understand that the DESH bill has been presented in Parliament, and we're yet to know whether it's being passed or not. But once it is passed, that will be a huge impetus to the SEZ projects that we have.
Sure. And lastly, on your hospitality portfolio, from the hotel chains that have reported the numbers so far, we are seeing 20-30% sequential growth in revenue for them versus 10% in your hotels. So if you could elaborate more on the reason for the same, and when do you expect this to pick up, and will any material upgrade to this bring in hotel monetization plans back on the table? That would be my last question. Thank you.
Yeah, so if we're comparing from this same quarter last year, there's been a significant increase in our performance. But quarter to quarter, they have very healthy occupancies. Most of our hotels are at 75 to 80% plus occupancy. Maybe the overall portfolio is slightly down because 1 or 2 projects in Gift City and Kochi. But otherwise, the hospitality portfolio is doing extremely well. There's a good traction in occupancy, but also the ARR and the AGOP. Like I said, it's been a good few quarters. The hospitality industry and our portfolio has bounced back really well post wave of COVID, and we expect this to continue. As I mentioned last time as well, it's a good time to sort of look at potential monetization of the portfolio. So we're in open discussions, and at the right time we will share if anything crops up.
Karan, I would like to add that you cannot compare, because all hospitality has a different portfolio in their hotels in their portfolio. So some has luxury, some has business. We are pure business hotels. So there will be some difference between the EBITDA numbers which you will compare with other hotel group companies within which we can call as our peers.
Sure. But if I look at the markets in which you are present, is it fair to say that the growth that you are seeing is in line with the industry or perhaps the market growth in the respective markets?
So, hi, this is Vineet here. In fact, we are ahead of the curve in our respective market. I'm happy to say that. And January, in fact, also we have finished ahead of budget. February is looking good because of the Aero Show and, the India Energy Week that went through. We have seen some historical ARRs in a couple of our hotels. So things are looking well.
Sure. That's it from my side. I'll come back in the queue. Thank you and all the best.
Thank you.
Thank you.
The next question is from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Yeah, hi team. Congratulations on a good quarter. So my first question is on residential Pavitra. Pavitra, we have launched 2.5 million square feet and now we're planning to launch 2.5 in fourth quarter. So out of the total 5 million, how much will be the new projects and how much will be the subsequent phases of existing projects?
Predominantly all of it has been new projects. There has only been maybe 0.5 million that was in the subsequent phases of a project called El Dorado. Apart from that, everything else is a fresh project. This quarter we will have actually a subsequent phase of our plotted development, but as part of the overall launch, it is not a huge number.
Okay. And just on the business development, so what has been the traction during the first 9 months in terms of million square feet added and also in terms of development value? You can highlight that.
Yeah. So in the past quarter, we added one property. It is in southwest, basically West Bangalore. It will be a commercial property. It's around 3.3 lakh square feet. The GDV would be around 200 crores. In the previous 2 quarters, we have actually indicated those launches before. We added a residential property in East Bangalore. That is around 2 million square feet. And in Q1, we had added a 75-acre property that was a land allotment by the KIADB. So the projects that we added in 9 months FY23.
So what will be the total development value of the 2 million and the 75 acres KIADB?
It is still work in progress. The design development is going to happen, and it is a mixed-use development. So it is a bit premature to say what is the overall, the potential for revenue, because part of it could be sale, part of it could be only lease, etc. So it is maybe it may take another quarter or two for us to firm up.
On the residential property, that would be around 1,500 crores.
That's 2 million square feet.
Sorry?
That's 2 million square feet, which you said you have added.
Yeah,
2 million
square feet. These are conservative numbers, of course. We'll look at how that pans out.
Just on the pending land payments of about 966 crores, so how is it split year-wise? So have we made the payments for the Mount Road property? So you can give some sense how the CapEx will be split.
So most of our land bank is with the visibility of developing within the next 3 to 5 years. So predominantly a lot of it, if you look at the numbers, we've already paid around 45% of payments towards that. And more or less, since we are talking about the launches also happening within the next, say 4 to 8 quarters, we expect a lot of it will happen in the next 2 financial years itself.
Okay. And just the last question on the not taking this SEZ benefit and arranging SEZ creation of the deferred tax asset. So what is exactly why it has been done? So
your voice is not clear actually. You are talking about the deferred tax.
Yeah, sir. I was talking about the deferred tax creation. Asset creation, not availing the SEZ benefit in Teringudi SEZ. So just wanted a reason why it take that.
So see, yes, it's a strategic call which we have taken because we have a residential also in non-SEZ and a lot of profits are coming there, and we think because of the slow leasing which had happened because of the COVID, though we will profitable by next 4-5 years, but we thought since residential launch will be there and that will be a good profit, this will help us to not to take SEZ benefits, and of course that's why we have created deferred tax this time on depreciation on PREPL as well.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. The next question is on the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity and congrats on good operational performance. First question is on hospitality margins. So this quarter we had a margin of 21%, while occupancy remained stable quarter on quarter and there was a growth in ARR as well. But margins were down by at least 1%. Last quarter it was 31%. Right now it is 21%. So 10% decline in margin. Any reason for that?
So there was one-time expenses which has come into hospitality. That is the reason that it has gone down a bit. But next quarter we'll see that it will return to 31 to 35% again.
Okay, got it. And secondly, on business development and while we have a good chunk of cash with us, what's the sort of pipeline we are looking at in terms of business development which are in advanced stage of discussion right now?
So we are looking across Bangalore and Chennai predominantly, while we are looking at Hyderabad also. A lot of the traction seems to be happening in Bangalore and Chennai. It's a mix of outright as well as JD. So capital requirements will be adjusted accordingly.
Any guidelines or guidance or pipeline number you want to provide in terms of what's there in terms of advanced discussion, which probably can close out in next 6-12 months?
No, actually, I wouldn't like to give guidance on that because it, sometimes things can be very difficult to predict. But we are in advanced stages in quite a few of these properties, and we're hoping to disclose that in the coming quarters.
Sure. And lastly, on your logistics business, so what sort of investment quantum we are right now planning to invest in next maybe 3 years or 5 years time period? Considering we have already acquired one project in that business, so what sort of investments in that land parcel and other land parcels which we might be planning to acquire? What's the total investment in that business right now?
So hi, this is Amar here. So basically we have invested into the land for a 25-acre development, and which is about under 100 crores. And we have this new allotment also, which is a mixed use with 75 acres, out of which largely the majority of it will be industrial and it will be a mixed use with residential and office. So based on FSI achievement, we'll come out with specific numbers a little later. But the land cost on the 75 acres will be close to around 200 crores.
That's the only 2 land parcels that we are looking to develop in near term, or there is further investment also planned in this segment. I am overall looking at the quantum of investment you would have planned or strategized for in this segment for next 3-5 years.
So honestly, for now we want to take it step by step, and we want to review these 2 land parcels, monetize these, and then look at opportunities later on.
Sure. Just lastly, if you can provide the collections breakup between residential, leasing, hotel, and others.
You want for Q3?
Yes, Q3 only, yes.
So residential is 884 crores. Commercial sale is 52 crores. Commercial lease is 137 crores. Retail is 56 crores. hospitality 126 crores, and PMS, which is a maintenance activity, is around 74 crores. Total is 1329 crores.
Sure. That's it. That's it from my side. Thank you. All the best.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. My first question is on the demand, as in...
Mr. Mohit, sir, there's a lot of disturbance from your line.
Yeah, is this better?
Sir, slightly better. Please proceed.
Okay. Is this better?
Yes, sir. Please proceed.
Okay. Thank you. So with interest rates, mortgage rates are at 9%, have you seen any change in footfalls or change in conversion time for any part of your portfolio, let's say the affordable mid-income portfolio? So any color on that? In that context, so you've already said fourth quarter looks to be very good, but how do you look at FY24 growth numbers in pre-sales?
So hi, this is Pavitra. So interest rates, obviously that is a big question for everyone, especially on the backs of yesterday's increase. But up until yesterday, we had not really seen any major impact, definitely not on footfalls. I think the percentage of people going for home loan versus not doing mortgage is staying fairly consistent. So I think so far it has not been too much of a change in the way people are looking at a real estate investment. In terms of what we're planning for the next quarter or so, as I mentioned earlier, we may not be able to give actual guidance, but the way the Q4 is panning out with the launches that we have already been doing in January and February so far, and what is planned for the next 4 months on a rolling 4-quarter basis, I think we will have a good showing. We will need to see, of course, if yesterday's repo rate increase and then the impending impact on home loan rates in the next, say, 2 to 3 quarters, will it actually have an impact? But thus far, reduction in interest rates had actually brought people to actually transact. The increases don't seem to have impacted the demand.
I will add to Pavitra. See, home loan rates are generally 15-20 years loan. So though immediate impact may be there on the sentiment part, but they also know that there will be a reduction cycle which will follow because RBI has indicated that this is one of the maybe which will be there. So that doesn't dampen for the people to buy the house. Secondly, I would also like to highlight when there is an increase in interest rate, the adjustment is done in the duration of the loan, not in the EMI. So since EMI doesn't increase, it's good for the buyers. They continue to hold the property. So let's see. But yes, definitely increase interest rate, as Pavitra said, may have some impact, but we have to see that.
Okay. And so my second question is, looking at your capex projects over a medium term. So right now you have twin towers under construction. How do you look at, in your initial comments you mentioned that retail malls are doing very well. So how are you looking beyond twin towers? How are you looking at investing in capex projects? And let's say 5 years out, how do you see the current portfolio, both in terms of retail and office? If you could, give some color on that.
See, the business, office business, like any other business, is also quite cyclical. After, twin towers, we also have another joint development project called Brigade Padmini Tech Valley, which is also about 1.25 million square feet. And whenever there is a crisis in the West, invariably the outsourcing increases. So that way, whatever slowdown in decision making by the tenant.
Ladies and gentlemen, the line of the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, sir.
So to continue from where the line got disconnected. So the decision-making delay currently is we anticipate it as a temporary phenomenon. Maybe a quarter or two it may take for things to be restored. Because overall, the sector, information technology sector, broadly speaking, with a huge amount of digitization taking place all over the world, the demand for office space, demand for talent, demand for work connected with software is only going to go up. And as I say in many areas, India's share in the global software market is still less than 10%. So that way the opportunities for us is huge, and the things should settle down, and whatever we see is a blip in the overall leasing scenario.
Yeah. So, sir, this second project, Padmini Tech Valley that you're talking about, is it for lease or for sale? And has the construction commenced?
It is about 1.25 million square feet, of which about 0.35 million square feet is nearing the completion, though we are not talking about it much. The balance work has just started, and it is a combination of lease and strata sale. There are 3 blocks in it. We may sell 1 or 2 blocks and retain the remaining. Depends on various factors, including cash flow and the leasing rates, everything.
Okay. And sir, last one. On the Twin Towers, currently, are we looking at doing 2 million, or we are focusing on currently 1.2 million? What is the status on acquiring the TDR?
Currently, it is 1.3 million because we have the TDR. We need to acquire only a little bit more. But it is a government policy which has held up for the past few years on TDR. So it will be about 1.3 million square feet now. And as and when the government allows TDR or change in rules, the development control rules, we may relook at increasing the overall leasable area, because the foundations, etc., are meant to take higher area and increase number of floors, and it has been designed that way.
Okay, understood, sir. Thanks a lot.
Thank you. The next question is from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead.
Thank you. Good afternoon and congratulations on a good quarter. So my first question is on the cash flow. So residential, you are selling a lot and collection is also going up, and that is also very, very negligible. So sir, what kind of free cash flow are you seeing in residential, maybe in FY23? What kind of free cash flow should we see in residential?
See, the maximum of the amount in residential is stuck in RERA. So, but there is free cash flow. We'll have a free cash flow of around 300 to 400 crores, which is coming, which has come till now from the residential. Barring that, we may have around 700 crores or so balances in the RERA accounts. So whatever we can take it out as a 30% as per the RERA requirement, we are taking it out and keeping as a free cash flow. Whatever is required by RERA commitments, it's in the RERA account.
Okay. And sir, I've asked these questions again, but I'm repeating it. So so many competition entering in Bangalore, and Bangalore seems to have the capacity to absorb everyone. So are you seeing, because you are deploying this rich cash flows, you are looking for deals predominantly in Bangalore? Do you see any change in expectation from the landowner, or it is business as usual what you are seeing in the last 2-3 years? it is the same now, or the expectation has gone up, or quality deals, the velocity has gone down? Are you seeing any change in terms of business development?
See, the competition can always be expected in any growing metropolitan city. It is something which nobody can stop. And Bangalore is growing at a pace wherein, the market is big enough for many players. In fact, in the recent post-COVID, the number of active and reliable players have come down drastically from the existing people. So that way there is a scope for new entrants also. And as regards the landowner expectations, it is a perennial problem. The expectations are always high. It is trying to bridge the gap and meeting their expectation at the same time, you having the developer having a decent return for the efforts is the challenge in the business. That is the speciality of challenge in real estate. Each business will have its own challenges.
Okay. And one final question, sir, on the leasing part. If you are once you are fully leased in Tech Garden and WTC Chennai, what kind of exit rental should we see in your leasing arms?
It will be around 750 crores to 800 crores when the exit rental happens at the full lease of all the property.
Okay, sir. 750 to 800 crores?
Full 750 to 800 crores.
Okay, sir.
Yeah.
Thank you, sir.
Thank you. The next question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hi team. Thank you for the opportunity. I have a first question regarding the P&L of leasing business. There's a there's a drop in the EBITDA margin in this quarter. Can you please highlight the reason for the same?
Not too clear. If you could just repeat that again.
Okay. So if we go to the individual P&L account of the segment, in the leasing business this quarter, the EBITDA margin was very lesser compared to previous quarter. Any reason for that? Leasing business Q3 margin was 69.4% EBITDA margin, whereas earlier quarters are 72, 73, and 75 also. Hello.
So see, if you see, there is a rental increase also. So stabilization of rental requires some time. That's why it is impacting a margin, because your expenses get immediately absorbed while your leasing is still going into full swing. So this is a temporary phenomenon. It will again come back to the original level maybe the next quarter.
And okay, so 74-75% will be maintained when at a full occupancy.
See, 73-74 is lease rental is still being maintained if you see the 9 months numbers in the leasing segment.
Yes. Okay. And sir, second question from my side regarding the launch pipeline. Like in the previous con call, we had highlighted that we'll be targeting a launch of 10 million and above in the next 1 year. But if we look at this quarter PPT, the launch pipeline is 9 million, and out of that 1.4 or 1.5 is a JV partnership. So effectively, the launch pipeline for the Brigade will be less than 8. I just want to understand why there's a delay in why there's a lesser pipeline. Has the projects got delayed? Few projects.
Hi, this is Pavitra. So on the launch side, yes, a couple of the projects in Chennai, we see it maybe getting delayed by a quarter or so. We're working to get that as soon as possible in the land bank. Also, the area that we've said we will be launching is a 100% area, so it includes the landowner share, but that's how most do report it as a 100% number. The other change to our launch pipeline, we have actually looked at overall and tried to actually predict what the launches would be in terms of RERA phasing. So last year, when we communicated, in the past we've been communicating a 100% full project launch. But technically, that's not how some of our projects get launched. We may launch them in 2 or 3 phases. So we felt that this was more appropriate in terms of communicating how the launches would actually happen. When they enter the land bank, we would be talking about 100% value. But when it enters the launch pipeline, if there is a RERA phase, then we would be only talking about the RERA area that is going to get launched on a rolling 4-quarter basis.
So if my understanding is correct, for the next 4 quarters, as per the RERA, we will be launching around 8 million square feet. Is that my understanding correct, my understanding?
I communicated 9 and subject to approvals, and already in that 9, we have launched 2.5 this quarter.
Okay. And so you mentioned in your earlier questions also, or question and answers, that we are in the discussion for a land acquisition in the Chennai and Bangalore market. Can you just highlight, because we have a great amount of cash now, so what is stopping for a land acquisition? Is it because the lands are not coming at the price that you wanted, or is the location is not? What is leading to a delay or for the land acquisition?
See, the lands have been tied up. What is, whatever we have spoken about, 8-9 million square feet new launches, they have all been tied up. In some cases, there has been a delay in compliance by the landowners, which will also happen, and bit of delay in due diligence, in other words. And whereas the design development work is in substantial progress. So it is only the Brigade is ready. Sometimes the landowner side there will be some delays. That is what is holding us.
Okay. Thank you very much. Thank you.
Thank you. The next question is on the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for the follow-up opportunity. Just one question on plotted. So if I compare from last quarter to this quarter, our potential as a plotted development project has declined a bit. I think last quarter it was 1.8 million square feet, now 1.4 million square feet, as highlighted in the land bank slide. Is it because 0.4 has already been launched and hence it has been removed, or what's the case? And just again a follow-up on that, our share in that is only 0.6 million square feet, or that is 40% around. Plotted are anyways a very a comparatively low realization project. So what's the strategy with such a low share in a plotted project?
Yeah, so first of all, you're right. The reduction in 0.4 is because we launched part of the Brigade Oasis that we mentioned in the opening remarks. We launched it last quarter, and we also sold out of the entire phase last quarter, and hoping to launch the remaining this and next quarter. We also have another plotted project in Mysore, which we are launching this quarter, and hope to inform you good results. Regarding the share, yes, we've communicated 100% share in terms of what would be launched. Typically, the dynamics in a plotted development, because you're not doing built-up area, it tends to become a larger share to the landowner. So I think what we've done is fairly, in terms of terms, to the landowner, we are pretty much at market or maybe better than market.
Oh, okay, got it. That's it from my side. Thank you.
Thank you. The next question is from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead.
Sir, just one question. The increasing sales value that you are witnessing in the last 3 quarters, and sir, where is this coming from? Is it increasing your market share in Bangalore, or market itself is growing? Because why I'm asking this question is, going forward, from where you are seeing growth coming? Is it like Bangalore itself is growing at a very fast rate in terms of real estate market, or or your share in the Bangalore market is growing, or maybe from geographical expansion such as Chennai and Hyderabad. So how are you seeing from where the growth will come going forward?
Average realization increase that you've seen is definitely because we have been able to take up pricing across our entire portfolio, not just in the last few quarters, but consistently maybe for the last 4 to 6 quarters itself. Also, from the projects that we have already sold in Chennai and Hyderabad, realization has increased. In the coming quarter or so, we may have lesser contribution from and Hyderabad because we pretty much sold out of our inventory in those two markets and working on the new launches. So you may see some stabilization of the APRs, the ARRs that you're seeing today. So going forward, as we have, as we launch new projects, we're actually able to see that we can drive pricing substantially even in period. That is what our teams are doing on the ground. We've demonstrated that across all the new launches that have happened in FY23, and I think we can continue to do that. And as we get our launches in Chennai coming up over the next, say, 4 to 6 quarters, then also we will see an increase in the average realization.
Actually, I think I could not. So basically, what my question was, ma'am, from where do you see the growth coming? Would the growth come from Bangalore growing itself, or your share in Bangalore market will grow, or from geographical expansion such as you increasing your market share in Chennai and Hyderabad? So that was actually my question. I mean, from going forward, how do you see this growth momentum?
No, the answer is both. Both our share also is growing, and also the overall business in the city is also growing. Now it has, I think, crossed the pre-COVID levels, even in the residential, which was not the case in the last 2 years. So the answer is, as I said, our share in the market is growing. Bangalore is also growing.
Okay. Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Hi, team. Just a question on commercial real estate lease pipeline. So earlier in the call, you did mention that you're focusing on leasing out BTG and the BTG Chennai. So how big is the pipeline for this, and how much leasing are you expecting in the fourth quarter?
So we've been doing quite okay. In fact, this past quarter, we managed fresh leases of 425,000 square feet. In the coming quarter, we should look to be doing something similar or more. Like I said, there was some slowdown and slowness in uptake of SEZ areas, which is where the vacancy is. Otherwise, almost every other project of ours is almost completely leased out. We are trying to be as aggressive as we can given the market conditions, but it should take at least 2 to 3 more quarters, it looks like.
Okay. Thank you, Nirupa, for your answer.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. As there are no further questions, I now hand the conference over to Ms. Pavitra Shankar, Managing Director, for her closing comments. Over to you, ma'am.
Thank you all for listening in. Before we end the investor call, we'd just like to take you through some non-financial highlights. As part of our thought leadership initiative through Brigade REIT, our tech accelerator, we hosted Propagate on the 29th of November to bring together industry thought leaders, key influencers, and startups to inspire each other. We received over 500 registrations from leaders in the PropTech ecosystem, including startups, VCs, developers, incubators, accelerators, and academia. We witnessed some very engaging and thought-provoking discussions focused on the role that technology plays in enabling smart infrastructure for a better tomorrow. An important internal initiative called Sampurna Parivartan 2.0 Catalyze is our digital transformation journey. Through this program, we've simplified and further digitized processes with a focus on improving customer experience. It was very fulfilling to receive in December the Realty Plus Award for the Best Customer Connect Initiative of the Year for Brigade's Here For You Customer Feedback Program. We also won the award for Best Digital Marketing Campaign for our flagship sales event, Brigade Showcase. We think it's fitting to touch upon the recently announced budget. We believe the infrastructure spending of 10 lakh crores is a step in the right direction and is expected to have a positive cascading effect on all sectors. With respect to real estate, the extension of tax benefits for relocating to GIFT City till 2025 will enhance business activities in the region. Support needed, such as industry status for our sector and a relook at the GST rates on cement and loss of input tax credits, did not find a mention in the budget. Public-private partnership initiatives announced to promote tourism and to identify 50 projects for last-mile connectivity improvement. The addition of 50 airports, heliports, and waterdromes will also benefit the sector. Brigade's flagship CSR initiative in arts and culture, the Indian Music Experience Museum, or IME, recently organized the Rhythm Exchange Festival, a culmination of the year-long collaboration with Manchester Museum in the UK and supported by the British Council. The festival brought together Indo-UK musician mentors and mentees to explore rhythm as a shared language between East and West. IME brings top-quality knowledge and networks in the classical music space and showcases musical pop culture including Bollywood, tribal and folk music, contemporary music, and independent singer-songwriters, spanning a range of genres, even rock and hip-hop. IME is a fantastic place for all generations to visit together. So if business or pleasure brings you all to Bangalore, please take some time out for this unique experience. I'm also extremely happy to share that our chairman, Mr. Jaishankar, was felicitated at the South Indian Hotels and Restaurants Association Awards for his contribution to the hospitality sector. With that, we now wrap up our Q3 FY22 analyst call. Thank you all for taking the time to hear from us today.
Thank you. Ladies and gentlemen, on behalf of Brigade Enterprises Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.